Welcome back to the deep dive. Okay, so you know how sometimes you look at your investment portfolio and you may be wondering, how do I really grow this beyond, say, just the US? Or maybe how do I actually protect it when markets inevitably do their thing and get a bit wild? It's kind of that classic investor challenge, isn't it? Trying to navigate those market swings, but still aiming for solid growth. All right, let's unpack this a bit. Today we're doing a deep dive into something called currency diversification. Now, this isn't just some jargon you hear thrown around. It's really about understanding a pretty powerful strategy, like how putting different currencies into your investment mix can, well, potentially boost your returns and act as a kind of shield against various risks, making your money work smarter globally and maybe with a bit more resilience.
Yeah, and what's really fascinating here, and this is the core of our deep dive today, we're actually pulling insights straight from a September 2025 financial newsletter. It's by Genti, a really respected strategist, CFP, CAIA. And their whole focus in this piece is exactly that, how currency diversification can lift returns and, crucially, mitigate risks for investors like you listening. It's a very clearly argued case for a strategy that, honestly, often gets a bit overlooked or maybe misunderstood.
Precisely. And that's our goal today. Give you that shortcut, get you well informed on this. We're going to uncover some maybe surprising facts and really show why this isn't just for the big hedge funds. It's actually really relevant to your financial strategy, even if you don't think you have currency exposure right now. By the end of this, you should have a much clearer picture of how to think about the currencies that make up your wealth.
Okay, so let's kick things off with something from a source that might genuinely surprise some people. A lot of investors, well, they might not even realize they already have exposure to foreign currencies. It's not always like an active choice you make. Sometimes it's just, it's there.
That's such a key point. And it's way more common than people might think. The way this usually happens is when you invest in what people call global portfolios. So if your money's in international stocks or maybe mutual funds, ETFs that hold assets across different countries, you're kind of indirectly accessing a whole mix of international currencies. It's not just owning a foreign company share. It effectively broadens your asset base beyond just, say, the US dollar, whether you planned it or not, like invisible threads connecting your money globally.
So even if I just bought into like a global fund without thinking about currencies, I might be getting some benefits already. What are those initial advantages, even the accidental ones? What's the hidden benefit here?
Absolutely. It's like a silent shield almost. The newsletter points out that even if you didn't explicitly plan for currency diversification, those foreign assets, they're inherently making your portfolio a bit tougher against shocks right here at home. Think of it like an invisible layer of protection. When the local economy stumbles or the domestic market dips, those foreign currency bits can offer some stability. It's a really neat safeguard many investors don't even realize they have: resilience during volatile times.
Okay, that makes sense, like a backup generator, maybe, for the portfolio. But let's dig a bit deeper. How does this actually work? What's the core mechanism? How does currency diversification manage to potentially boost returns and cut down risk?
Right. So at its heart, the reason it works is actually quite, well, clever. It's like a balancing act. By spreading your investments across different currencies, you're essentially offsetting the ups and downs that any single currency might face. I mean, no single currency is strong all the time, right? When one weakens, another might strengthen or maybe just hold steady. It's this balance, not putting all your eggs in one currency basket, that can enhance overall returns while smoothing out the ride, risk-wise.
Okay, this is where it gets really interesting for me. Let's use that specific example from the newsletter. It really clarified things. Think back to 2022. The US dollar was, incredibly strong, appreciated over 10% against other major currencies, mostly driven by the Fed hiking rates aggressively, trying to tackle inflation. Now, in that situation, if you held assets denominated in, say, euros or yen, those holdings actually acted as a kind of hedge against US inflation pressures. Almost seems backward, but it worked. And even better for a US investor, your stronger dollar meant you could buy more foreign assets cheaper, getting more bang for your buck overseas.
Exactly. And to show the flip side of that, the other side of the coin, consider maybe 2018, 2019. During that period, emerging market currencies were generally weakening, lots of pressure from trade stuff, global growth worries. But for investors who had diversified portfolios, they actually benefited from the stability of the US dollar. Their dollar holdings acted like a cushion, protecting them from bigger losses they might have seen if they were all in on those weaker emerging market currencies. It really shows how different currencies act as counterweights, depending on what's happening globally.
And the data backs this up, right? The newsletter mentioned the MSCI World Index.
Yeah, that's a big global benchmark. Tracks stocks across developed markets.
Right. And it shows historically that currency diversified portfolios have actually delivered, what was it, 1 to 2% higher annualized returns, higher than non-diversified ones over the last decade or so. And crucially, with less volatility, fewer scary swings. That lower standard deviation basically means a smoother ride.
Yeah, less bumpy.
So potentially high returns, less risk. Sounds pretty good.
It's a powerful mix. But, it leads to another thought. Beyond just boosting returns, how else does this diversification shield your wealth? What are the defensive aspects, especially now, with inflation being sticky and all the economic uncertainty floating around?
That's a really important question. And in a time like now where inflation seems persistent and central banks are all doing different things, some hiking, some not, currency diversification really stands out as a kind of natural defense against that inflation. It's not just about asset performance, but the actual buying power of the currency those assets are in.
Exactly right. And the newsletter highlights a particularly smart strategy here. Allocating to currencies from commodity exporting countries, think Australia, Canada, their economies are really tied to global prices for raw materials. So when global inflation picks up and commodity prices, oil, metals, etc., tend to rise, their currencies, the Aussie dollar, the Canadian dollar, often strengthen right along with them.
So it's like a built-in inflation hedge. My home currency might be losing purchasing power due to rising prices, but my investment in, say, Australian dollars could be gaining value partly because of the commodities driving that inflation. That's clever.
It is.
And the source says sophisticated portfolios often do this to protect long-term buying power.
Precisely. It's a way to guard against that slow erosion from inflation.
Definitely. But let's shift gears slightly from economic pressures to, well, geopolitical risks. Just as unpredictable, right? Things like trade tensions flaring up, sudden political instability somewhere important, unexpected policy changes. These things can trigger really sharp, sudden currency moves.
Yeah.
And that's where diversification isn't just nice to have, it becomes a critical shield.
Right, and this is where that dramatic example from the source comes in. Really drives it home. December 2024, the Korean won. Huge volatility. Remember President Yoon Suk-yeol's very short-lived martial law declaration? Total shock. The won dropped 6% against the U.S. dollar, just like that, in 1 month. Shows how fast political events hit currency values. You nailed the key point there. For investors who are strategically spread out across other major currencies, U.S. dollar, euro, maybe others, they largely sidestepped the kind of concentrated losses you'd see if all your money was tied up in one denominated assets right then. Their diversified holdings acted as a buffer, benefiting from the relative stability elsewhere. It really mitigated the impact of that political shock.
Wow.
It's a really clear example of managing that kind of geopolitical risk.
And thinking about our international listeners, especially maybe those in Korea,
Yeah.
this point is even more direct, isn't it? The source mentioned that Korean clients investing in U.S. dollar assets, they could have seen an extra currency return, something like 17% over 5 years.
That's right, about 17%.
On top of any gains the actual assets made, that's huge.
It is. It really highlights the kind of hidden value strategic currency choices can unlock, especially if your home currency tends to fluctuate more. And building on that, especially for someone whose main wealth is in a single currency, like the Korean one, the strategic value is clear. Investing in U.S. dollar assets gives you real diversification. It directly tackles the risk of local currency drops. Like, remember 2022, the won fell about 15% against the dollar. That hits local buying power hard.
Right.
So this strategy gives stable access to USD returns, taps into the strength of the U.S. dollar, and reduces that single currency reliance risk.
Okay, so we've seen how it can be a shield against inflation, geopolitics, maybe boost returns. But what about someone who thinks, okay, I want global stocks, but I'm just nervous about currency swings messing things up? Can you get the equity exposure without that extra volatility layer? The source mentioned ways to handle that.
Absolutely, yeah, for clients who want that global equity piece, but without the currency risk factor, there are definitely tailored options. The newsletter talks about strategies designed specifically to neutralize exchange rate volatility.
Okay.
We're talking about things like currency hedge strategies or specific ETFs, exchange-traded funds that use financial tools, forward contracts mainly. These basically let you lock in an exchange rate for the future, so your investment isn't getting knocked around by daily currency fluctuations.
Well, okay.
The idea is that your return then comes mainly from how the underlying asset performs, not from whether the currency went up or down. Takes the currency prediction out of it.
That makes a lot of sense.
Yeah.
Remove some of the guesswork. So for listeners who are thinking, okay, I'm interested, how do I actually do this? What are the practical steps the newsletter suggests for implementing currency diversification?
Yeah, the source lays out a pretty clear path. Step one is always review your portfolio, really understand your current currency exposure. Like we said, people are often surprised. Then you customize allocations. Often using diversified ETFs or mutual funds is the easiest way, as they hold multiple currencies already. For a sort of typical diversified portfolio, the recommendation is often targeting around, say, 20 to 40% in non-U.S. dollar holdings. But that's adjusted, obviously, based on your own risk tolerance, your goals. Now, for international clients, like we discussed in Korea, looking to diversify away from a concentrated home currency, the recommendation for their U.S.-focused portfolios is quite different, maybe allocating 60 to 80% into U.S. dollar assets. That lets them tap into the U.S. system's strength and depth while actively diversifying away from single-country risks back home. It's about being really intentional.
So wrapping this up, what does this all really mean for your financial future listening in?
I think the core message from this deep dive is pretty clear. Currency diversification isn't just some fancy way to maybe chase higher returns, though that's part of it. It's really a fundamental tool for building a portfolio that's more resilient, more stable, more strategically sound. It gives you that crucial protection against inflation's quiet creep, against sudden geopolitical shocks, and just the normal ups and downs of any single currency. It's about making your financial future stronger, more prepared for whatever the world throws at it.
And that's exactly why just being informed about this is so valuable. Understanding your own currency exposure, knowing the risks, seeing the options you have to manage it, that can be a real edge in today's global economy, which is, let's face it, interconnected and often pretty volatile. It's about taking control, being proactive with your wealth, not just reactive.
Exactly. So maybe a final thought to leave you with. Considering how connected everything is, markets, economies, how might a deeper grasp of currency movements really empower your next financial move? And thinking bigger picture, what role will currency diversification play in protecting your long-term buying power, your wealth, in this constantly changing world? Definitely something worth thinking about as you plan ahead.